So let's talk about break even when we've got a mix of products. So most companies don't sell just one type of product. They've got several different product lines, and companies that provide services, they probably have several different services that they provide, and each of those products or services will have their own selling price and their own cost structure. So if we have more than one product line, we do need to do a slightly different calculation for our break even in units and break even in dollars. As you can see, these are almost identical to the break even when we have a single product line. The only difference down here for units is that we need to do a weighted average of the unit contribution margin. And then break even in dollars, what we're going to do is basically add up all of our product lines, and then we'll calculate the break even in dollars, just like you would if we had a single product. So let's do an example. So we're going to look at break even in units first. We're given that our sales mix is 70%, 75% of our sales are product A and 25% of our sales are product B. Our total fixed costs for the company are $88,000. And then we've got a contribution margin statement for product A and product B here by unit. So for each unit, the selling price is $14 for product A, $7 for product B. The variable cost per unit, $8 for product A, $3 for product B. Contribution margin per every unit we produce is $6 for product A and $4 for product B. And then of course, remember, our fixed costs are not dependent on any of our variable changes in number of product we sell, mix, anything like cost of each product we sell. Our fixed costs are always going to be the same regardless of what happens with the variable costs and the variable selling price. So let's first calculate our weighted average. And to do that, we're just going to take our per unit contribution margin and then weight that by the sales mix. So product A, the $6 is our unit contribution margin. We got that right there. We're going to multiply that by the sales percentage for product A, which is right up there. And that's going to give us a weighting of $4.50. And then we're going to weight our contribution margin for product B, $4, and multiply that by the sales mix of 25%. And that's going to give us $1 for product B. So once we add those two together, our weighted average is $5.50. We've weighted each of these contribution margins by the amount we sell of each type. So we're going to continue on the next slide, taking our weighted average of $5.50 with us. So our break even in units, again, this is almost exactly the same as when we have a single product. Total fixed cost, but instead of just dividing by our unit contribution margin, we're going to use that weighted average. So $88,000 were our fixed expenses that we were given in the prior slide. $550 was our weighted average that we calculated. And if we divide those, that's going to give us 16,000 units are needed to break even. So that's the number of units we need to sell given the sales mix of product A and B to cover all of our variable costs and to cover all of our fixed costs to ensure that we at least don't go negative. So this will give us a 0 net profit. If we want to break that out and figure out how many units we need to sell of each item, all we do is we take our total break even and then multiply it by the sales mix percentage. So 16,000 multiplied by 75% means we need to sell 12,000 of product A. 16,000 multiplied by 25% for product B means we need to sell 4,000 of product B. Okay, so that's a break even in units with the sales mix of more than one product. We'll next take a look at the break even in dollars. So we're given here that our total fixed expenses in this example are $27,000, and this is our product mix here. We've again got only two product lines. And if we want to figure out our sales mix, we can actually figure it out from this information. If you add together our sales for A and B, that's going to give us total sales of $100,000. And then if you just divide our sales in product B by our total, that'll let us know that 20% of our sales are coming from product A, and if we take our product B sales divided by total sales, that tells us that we've got 80% of our sales coming from product B. So this is our sales mix that we can calculate ourselves. So if we want to calculate our break even in dollars, you can see it's the same exact formula that we use when we only have a single product line. All we're doing is we're basically turning a multi-product system into a single product system by adding them together before we calculate the break even. So that's what we've done here. We've added our sales together, we've added our variable expenses together, and then this gives us the contribution margin for the company as a whole. And then we subtract out our fixed expenses, and that gives us our net income. So if we want to calculate our break even, we take our total fixed cost divided by our total contribution margin ratio. And to get our contribution margin ratio, we just divide our contribution margin in dollars by our sales number. So let's calculate that first. So we've got $45,000 as our contribution margin in dollars, and we're going to divide that by our total sales of $100,000. So that's going to give us a contribution margin, or sorry, a contribution ratio of 45% for the company as a whole. So if we want to calculate break even in dollars, that's our total fixed cost for the company as a whole divided by the total contribution margin ratio. So down here our fixed costs are $27,000 from right there. We're going to divide that by the contribution margin ratio for the company as a whole, which was 45%. So that's going to give us a break even for the company as a whole of $60,000. So this company needs to sell $60,000 to ensure that all of their variable costs are covered and all of their fixed expenses are covered as well. So if we want to allocate that by product line, if we want to figure out what we need to do in sales to break even for both of these product lines, we just take our total break even, $60,000, multiply that by 20%, which is the sales mix percentage for product A. That'll give us $12,000 for product A. For product B, we just take our total break even, again, $60,000, multiply that by the sales mix for product B of 80%, and that's going to give us total sales of product B of $48,000. So this is what we would need to sell if we want to at least break even. Okay, we won't have a profit from this, but this is what will cover our variable expenses and our fixed expenses. So let's talk about how the sales mix changes. So if we change anything in here at all, that was one of the assumptions of our break even that you read in the textbook. The assumption is that our sales mix doesn't change. This will be our break even as long as the sales mix doesn't change. If it does change at all, if the sale price changes, if the mix of the percentage we sell of each changes, if variable expenses were to change, then this break even will change as well. And we'll look at what a change in the sales mix looks like in the next lecture.